BDO in financial advisory services. The core of what I do is business valuations, and I've been working here for the last 4 years in specializing in exactly that, business valuation. So hopefully today I can teach you a few things, and you can have a better knowledge of what your business may be worth or where to go in order to find out what it is actually worth. So I'm going to discuss some concepts that relate to business valuations, but I'm going to keep everything at a very high level just so that it does remain applicable to all types of different businesses. First, I'll speak about the concept of business valuation and how a company's value can be determined. Then I'll discuss a variety of factors that can have an impact on value. Following that, I'll give a brief overview of items to plan for today in preparation for involuntary sale. And finally, I'm going to go over some steps involved in a voluntary sale. So like Carla mentioned, if you have any questions, just send us an item in the chat, and we're going to address the questions after the recording. So what's your business worth? In reality, there's only one true measure of a company's value. The value of a company is really the price that someone is willing to pay for it in an actual transaction. However, there's a variety of instances where you need to know the value of a company, but you can't be putting up the company for sale every time you want to know that. So if you want to do some tax planning, if you're looking for additional financing, if you're going through separation or divorce, you need the value of the company, and you can't just ask people to tell you what they're willing to pay for it. So an alternative to putting the company up for sale is to have someone review the company's net assets and its earning power. So without going into too much detail, the value of a company can be broken down into 4 components. And then in some cases, there is actually a 5th component. If you look at the blue box on the left of the screen, there's 4 boxes. I'm actually going to go through those 4 boxes and give you an explanation as to what that is and how it actually adds up to the value of the company. The first component is the easiest one to understand, and it's the net tangible assets. That's basically the market value of all the physical assets, which are all the assets that you can see, the assets that you can touch, and then from that you deduct the market value of the liabilities. In the most simple sense, that's the equivalent of the shareholders' equity on the balance sheet. And then that's subject to some adjustments just to reflect the market value of the assets and the liabilities, because usually in bookkeeping it's the cost of those assets that's recorded on the balance sheet. The second component of the company's value is the identifiable intangible assets. Those are the assets that you can't see, you can't touch, but they still increase the cash flow of the company. Those assets can be things like trademarks, copyrights, brand recognitions, things that could potentially be segregated from the company's operations, and things that you can sell on a standalone basis. Then the third component is goodwill. The goodwill is something that you can't see, you can't touch, and that you can't sell separately from the company's operations. The thing with goodwill is that it still increases the company's cash flow, and it's often hard for people to wrap their head around it because there's different types of goodwill as well. There's goodwill that can be transitioned to a purchaser. Then there's goodwill that cannot be transitioned to a purchaser. If you can't transition it, then no one would be willing to pay for it. Whereas if you can transition the goodwill, then people would actually give you a higher value for your company. So some examples of non-transferable goodwill is there's a grocery store, and everyone's going to the grocery store because they really like the individual who owns it. You can't transition that relationship because it's specific to the owner. Then there's no value to that type of goodwill. However, if there's a company who has a very strong brand name, some really good customer relationships, great reputation, and that's not specific to the owner, then that could be transitioned and someone would be willing to pay for that. Then I move on to the fourth component of the value, which is the redundant assets. The redundant assets are in essence the same thing as the net tangible assets, but the difference is that the redundant assets are not required in the company's core operations. So for example, if a company holds an investment portfolio, but it never actually uses the cash in its daily operations, then that's considered a redundant asset because you can actually remove it without impacting the company's core operations. So if you're trying to sell a company, the purchaser may not be interested in those redundant assets because it wouldn't actually be part of the core operations that the purchaser is interested in purchasing. So when you add all those four components together, you arrive at the company's total value. In some cases, like I mentioned at the start, there may be a fifth component of value, and that's from the special purchasers. The special purchasers are people or even companies who are willing to pay even more than the company's value. So they may be doing that for different reasons, such as gaining a strategic advantage, or if they expect to realize synergies when they combine the purchase company's operations with their own operations. So an example of that may be that there's rent being paid in your company. But if someone was to purchase your company, they could just take the operations, put them with their own operations, and just disregard the rent that you were initially paying. So that just increases the cash flow that they're going to get through their new, bigger company. So in summary, if you have those five components and you know the value of those five components, you have the value of a company. The next section, I'm going to go over some factors that affect that value that we just discussed. There is a visual example that hopefully is going to illustrate the importance of timing when you're preparing to sell a company. If we assume that each of those four companies operate in the same industry, and that at the end of the 2012 fiscal year, which is the pink column, all the four owners would decide to sell. The company 1 has seen its sale increase consistently over the last 5 years. So it's a good time to sell when the sales are trending upwards. However, in this situation, the forecast for the next couple of years is going to be extremely important to the purchaser, because that purchaser wants to know whether the sales are going to keep increasing or if they're just going to stabilize at that level, so the 2012 level. So you need to be able to provide some forward-looking information if you're going to sell the company in any of the situations, but specifically when your sales are trending upwards. In company 2, the sales have just been decreasing consistently over the last 5 years. In situations like that, the business owner would probably not get the best price for his company. So if you are in a situation where sales are trending downwards, you may want to hold on to your company for a couple more years and just try and put things back on track so that you can show a positive trending when you're going to sell. In company 3, it becomes a little bit more difficult to assess the value because the sales have been all over and there's not a lot of stability. That may be an indication that the company is not going to sell for the highest price, just because a purchaser would be looking for consistency. And when the sales are going up and down year after year, it's just an indication that that there's more risk attached to the company. And then the fourth company is shown stable results for the last 3 years, and it has a good track record of good stable earnings. Although that looks good, the timing may not be ideal for the sale of the company, just because the future growth potential of the company has deteriorated. So there's typically a higher value to your company when there's continued growth expectations. So you may look at the historical results because that's often the best information that's available, but you want to be able to demonstrate that going forward there's going to be a trend upwards or at least consistency in the earnings. So when I look at that, my conclusion would probably be that company 1 would get the highest price just because of the proven historical growth in the results of the company. Once you've decided to prepare for sale, you want to make sure that your company is attractive to a purchaser. You need to help the purchaser understand that there's potential in your company, and you want to show what it could become in the future. You need to identify what's called the key value drivers. So why would someone buy your company? What are the opportunities in the marketplace? Which buyer could benefit the most from an acquisition? What's unique about your company? And what growth strategies would drive success and differentiate you from your competitors? So all of those questions need to be asked in order to prepare the company for sale. The purchaser is going to be interested. And even sometimes the purchaser would be interested in what you would do differently if you were going to purchase the company. So maybe they want to take advantage of those lost opportunities that you had, and that may be an indication for growth in the future if they were to do things differently. The price that you're going to receive for your company is going to be influenced by how attractive you make your business look. So and also how credible those forecasts or those results looking forward are going to be. On the previous slide, I talked about those key value drivers. And the value drivers are going to be different for every single company. Every single industry is going to have its own key drivers. And if you're looking to increase the value of the company, there's some basic steps that are going to be the same for most companies. So you want to start by trying to strengthen your cash flow. You want to be able to show that your company is making enough money to generate a return on the investor's investment. You want to make sure that you control your cost. So if you have a lot of discretionary expenses in the years leading to the sale, you want to make sure that there's none of that going through. So perhaps there's cell phones or company vehicles. You want to keep that out because that just shows a stronger bottom line, and that's what the purchaser is going to be interested in. If you're able to, you want to start reducing your debt levels just because that shows a stronger balance sheet. And another way to do it, which is fairly common for all the industries, is that you want to try and develop your customer base. So you keep a list of all your past customers and your recurring customers and even your top 10 customers. That just shows that there's consistency in your results, and it helps show what your company is truly worth and why someone would pay to actually purchase your company. If you have some key employees, which are absolutely necessary to maintain the operations of your company, you may want to consider having some long-term contracts with those employees so that after the transition, it's actually harder for those key employees to leave your company. If you're involved in any type of litigation and perhaps you think that you're going to win, but it's going to take another 2-3 years in court, you may want to consider just settling anyway, because the purchaser is not going to want to buy your company if there's ongoing litigation that they're going to be stuck with. If there's reliance on the business owner, and for most small companies that rely on the skills and the relationship of the business owner, that's an issue. Where that's the case, it may decrease the value of the goodwill that we talked about earlier. So you want to set your company up in a way that it's not entirely dependent on you. And that's difficult because as the business owner, especially in small companies, your company's a little bit of your baby and you want to control everything. But if you can share the responsibilities, that may actually result in increased value to the company. For businesses that tend to fetch higher values during good economic times, because often there's just more capital available in the market, and the timing of the economy may impact the value of your company. And then there's the industry conditions. The industries tend to go through trends. Sometimes some industries are very attractive, and in other times there's very little interest in those industries. So just keep that in mind. If we think about the automobiles a few years ago, that was, and still I guess today, that wasn't the right time to sell. And if you're able to make it through those tough times and come out ahead, then when you do come out of a downturn, you may actually be able to get a higher value for your company. So it's important for business owners to just take a step back from the daily business duties and to understand what industry changes or developments could dramatically impact their company. If the company won't be able to adapt to external industry changes, then it may just be wise to plan for a sale right now. So if you have everything set up and you've gone through everything to set up your company for sale, you have the key value drivers, and you've been just keeping it very clean for the last couple of years. But the question is, do you actually have an exit strategy? Who is going to purchase your company? That's really the best case scenario would be a voluntary sale, when you're ready to step down and you find a purchaser, and you just get to sell your company for a very good price, you retire, and you live happily ever after. However, what people don't think about is the involuntary sale. What happens if you just die tomorrow, become disabled, or go through a divorce? I've covered most of the voluntary sale aspects, but in preparing for your exit strategy, you should really consider the possibility of the involuntary sale. So like I said, if you die tomorrow, what's going to happen? Do you have enough money to cover the taxes that you'll have to pay on the disposition of your company? What if you don't die but you become disabled? Do you have enough insurance to continue? What if there's a shareholder dispute and you don't have a shareholder agreement? What happens then if there's no way to get out for one of the shareholders? So all those items should really be considered when you're preparing for the exit of your company, and even in the day-to-day operations. Those are all things that should be considered, because you never know when the involuntary sale is going to happen. What can you expect when you're actually ready to sell your company? So the voluntary portion of it. There's different, it's a complicated process. It may be a long process. Some people get lucky. There's a purchaser that knocks at their door and says, I'm going to give you this insane amount of money for this company, and some people luck out. However, sometimes it's a longer process, and it takes a year, it could take 2 years. Sometimes deals don't work out. But most purchasers are going to ask to see pro forma financial statements. So most private companies are going to try to minimize their taxes, and they don't necessarily show the high profits in the company. So there's those discretionary expenses that I spoke about earlier that are going through the company, and that just shows a bottom line that's not as positive as you'd want it to be. So to prepare for the sale, the financial statements should be adjusted to eliminate the non-operating and the non-recurring expenses. That includes potentially a lawsuit that happened in the 1 year, but that would not happen in the future. There may be a vehicle benefit, income for a spouse, so we know that as income splitting, but the spouse doesn't really do work in the company or could be replaced at no cost to the company. There may be a family vacation to Florida or any other expenses that would not be incurred by the new owner. All those expenses should be identified for the purchaser so that they know what happened. And even if you have support for that information, that helps. And you provide those adjusted financial statements to the purchaser so that they get the real story behind how well your company is doing. And you want to consider how the transaction should be best structured from a tax and a risk point of view. So buyers typically like to acquire the assets, so they don't assume the seller's unknown liabilities, but the sellers prefer to sell their shares because then they transfer all those future liabilities to the buyer. So you want to be speaking with a tax expert with respect to that. And whether you sell the assets or the shares is actually going to be a different price point for your company. And then so that whole sale process. If you're preparing a company for a sale, depending on the complexity and the size of the transaction, you may be required to prepare some key documents. The first one is the confidential information memorandum. That's basically a marketing document, and it describes the company, its current operations, and its future prospects. The buyer will review the contents of the financial statements before deciding whether to make an offer or not, and those would be the pro forma financial statements that I described earlier. When you get into that, you want to have a non-disclosure agreement. So after signing the non-disclosure agreement, a prospective buyer may see additional company information. You don't want to be providing information to a competitor without having the non-disclosure agreement, just because you could turn around and just use that against you. So you want to have a lawyer involved in the early steps of the process, just so that you are protected and that your company is also protected. There's sometimes a bid process used to request expressions of interest. So the purchaser would tell you what they're actually willing to pay for the company, and then that can actually be used to increase the value of your company. Because if you have two parties interested and you create some kind of an auction atmosphere, then they will bid up the value of the company. So if you think about even eBay, when there's an open at the end, one person says $1 higher, and then the next person comes back with a higher price. So you can drive the value of a company up if you have multiple parties interested. Then finally, the transaction. So everything can be negotiated in a sale transaction. So the price can be negotiated, the payment method, or the assets that are actually sold. So when I spoke about the redundant assets earlier, those are assets that probably would not be part of the deal unless agreed otherwise. So if an owner's abilities or the customer relationships are key to the company's success, the buyer may require to have the seller just involved in the company post-transaction. So that's something to keep in mind, that even if you sell your company today, you may actually be involved going forward. And sometimes we see some earnouts. So the person selling the company may be extremely optimistic about the company's future, but the purchaser may not be so sure, so he doesn't want to pay the same price. So if you use an earnout strategy, you can actually get the purchaser and the person selling the company to agree on the price. So the solution with the earnout is that you base the payment on the future actual results of the company. So if the person selling the company was really optimistic and they actually reach those projections, then he would get the full price of the company that was initially desired. But if the company is not reaching those forecasts, then the person selling the company wouldn't actually have the full price that they were asking for. To avoid some pitfalls in selling your company, you want to start planning early. So if you plan at least 2 years before you want to sell, that allows you to do some tax planning. It allows you to clean up anything that needs to be cleaned up in a financial perspective. You want to take advantage of the company's strong past performance coupled with some good growth prospects. So make sure that you allow for sufficient transition period where the owner is actually actively involved. You want to analyze the company's operations to make sure that it's attractive to a potential purchaser, and you want to focus your efforts on initiatives that retain the major customers and your key employees. And then identify those key value drivers that I mentioned earlier. And you want to also identify some opportunities that can build value for the purchaser. You want to consider the importance of the balance sheet, and you want to manage the working capital of your company. You can complete some appropriate tax planning, which can help you realize some significant savings. And the key is just to speak with some financial, some tax, and some legal advisors, and they can often be worth the money that you pay them because they help you save a lot of money if things are planned appropriately. So that wraps up the formal portion of the presentation.